Good morning, dear students. How are you all? All good? Okay. So we are now almost in the third session, right? Or I can say, yes, 2.5 session of the topic of portfolio management in CA final AFM course. Now, we have covered quite a good number of concepts from this portfolio management topic. We have been looking at multiple ways of measuring the risk and return of an individual security, and as well as pertaining to a portfolio of securities also, right? So initially we understood how to compute the expected return from a security if it is based on probability. So we take the weighted average number, right? So we take the weighted average. If it's like probability given to us, the expected return can be simply calculated as sum of probability into the return numbers. And same way, the standard deviation can be calculated as summation of P into R minus expected return the whole square, and then you take the square root of it. We have also observed how to get the expected return and standard deviation of historical data, right? Then we went ahead with the portfolio, and we identified that portfolio return can be easily computed as a weighted average. But the interesting point lies in the calculation of standard deviation of the portfolio. Now, as far as standard deviation of the portfolio is concerned, we need to get involved the correlation part, right? And therefore, we also understood how to compute the correlation. So correlation was computed as, it's simply like covariance upon standard deviation of X, standard deviation of Y. And then this covariance formula can be further expanded, and we can arrive the correlation formula as per the formula that you can look on the screen. Okay. And then when we applied it, we were actually looking at it is getting matched. So the formula for portfolio variance was weight of X square into variance of X plus weight of Y square into variance of Y plus 2 into weight of X into standard deviation of X, standard deviation of Y into correlation. Or you can also say that instead of correlation, instead of using correlation and standard deviation, I can actually get the covariance form also. Okay. Then we try to create portfolio. We try to create the risk return profile of two securities with multiple weights and the varying degrees of correlation. And we observed that correlation was essentially instrumental in deciding the shape of the curve, right? So there we were really interested in knowing how to get the minimum variance portfolio, how to get the minimum variance or the minimum risk portfolio weights, which was simply computed by using this formula. If you want, let's say, weightage of security A, it will be computed as variance of B minus correlation between A and B into standard deviation of A into standard deviation of B, and then you divide it by variance of A plus variance of B minus 2 into correlation into standard deviation of A and standard deviation of B. Okay, so we can observe that as we were changing the correlation term, the line was getting changed. Okay, correct. So that was what we were observing, and then we did like a few questions for practice, where we computed the portfolio standard deviation, portfolio expected return, and then of course the minimum risk portfolio. The last concept that we did in the previous lecture was regarding the efficient and inefficient securities. So the securities or the portfolios are said to be inefficient if there is some other security which provides you, higher return, which provides you higher return at a lower risk, or higher return at the same risk, or provide same return at a lower risk. And all the set of those efficient securities are said to be the efficiency frontier. Okay. So now let's take it forward with further discussion on Markowitz portfolio theory. So today we'll be covering like Markowitz portfolio theory. Then we will be going ahead with capital allocation line, and then we'll discuss about capital market line, and of course then we'll be looking for the securities market line also. So that is our agenda for today. Then in the last session we will be taking up the remaining part, which is Sharpe's single index model and arbitrage pricing theory. Okay, so let's talk of details about efficiency frontier. Okay, let's talk of efficiency frontier, then we'll discuss about the utility, and then we will take forward with the Markowitz discussion. Now, let me just copy this particular portion to consider that in our discussion. Okay, so this was the curve which we had got in the previous class. Now, of course, here I'm not changing any of them, but if I ask you, like, you know, out of these portfolios 1 to 10, which of the portfolios are efficient portfolios and which are inefficient portfolios? Which of them are efficient and which of them are inefficient? Can you answer that, guys? Which of these portfolios are efficient and which are inefficient? Yep. Which of these portfolios are efficient and which of them are inefficient? Is portfolio 1 efficient or inefficient? This is, of course, inefficient, because the standard deviation in portfolio, is not that great. Because if I really want to look for the efficient portfolio, it actually starts from portfolio number 5 onwards. So this actually starts from portfolio number 5 onwards, because you can see that portfolio 5, there we can think of, one second, let me just erase this part. Yeah. From portfolio 5 onwards, this portfolio 5 onwards, there is a simple relation that we observe in the finance, which is high risk, high return. But whereas if I want to really invest, why the hell should I invest in portfolio 1, right? Because in portfolio 1, standard deviation is 10, whereas the return is 12. In comparison to that, portfolio 5 is a much better option, because that provides me obviously a higher return at a lower risk. So would any investor, in the market, will you observe that any investor investing in the portfolios 1 to 4? No. None of the investors would be really interested in investing in portfolios 1 to 4 for a simple reason: they are inefficient. No one would really be interested in investing there. So what we would observe in market, would we really be able to observe in the market portfolios 1 to 4? Will we be able to see in the market the portfolios 1 to 4? No. We won't see in the anyone investing in portfolios 1 to 4. Rather, your bare minimum investment would any investor would undertake would be in portfolio 5 onwards. So an investor would make an investment obviously from portfolio 5 onwards, from 5 till 10, depending on risk appetite. Every person has its has got its own risk appetite or ability to undertake the risk. So based on that, you will find that from portfolio 5 to 10 would be the preferred one. Any investor who is bit worried about risk, obviously he will be or she will be taking up the portfolio number 5, because that gives you the lowest standard deviation. Anyone who has got that guts, who has got that attitude for a greater risk, they can obviously go for higher levels of the portfolio. So in the market, considering the risk return characteristics, we won't be really finding these portfolios 1 to 4. So rather, the risk return line that we will observe in the market will be excluding this 4 portfolios, guys. This is going to be excluding the 4 portfolios. So, one second. Yeah. So, in the market that you see, when we initially created this portfolio, this line, we got it this way. One second. Yeah, we got the line to be this way. But as we observe that any rational investor would not be interested in these 4 securities. So rather what we will observe in the market is these 4 securities are not at all existing because no one is investing in them. So that will just go away. And what we would observe in the market is, a curve something like this, which is in the upward direction, which is moving in the upward direction. Now, this set of portfolios or this set of securities that we observe in the market, can you tell any one of them being inefficient? Do you think from 5th to 10th, anyone is inefficient? Is any of these portfolios inefficient? Yep. Is any of these securities or portfolios inefficient? No, all of them are efficient because they are basically fulfilling the criteria of high risk, high return. So there is no security or portfolio which is providing you, higher return at a lower risk or same return at a lower risk or, same, or I can say higher return at a same risk. So that is not happening in any of these portfolios, and therefore this is said to be the set of efficient portfolios or efficient securities. So what we will observe in the market is this set of efficient portfolios. And this set of efficient portfolios is what we call it as a efficiency frontier. So what is efficiency frontier, guys? Efficiency frontier will be simply set of efficient securities or portfolios in the market. So there's a full set of efficient securities or portfolios that we have in the market.
Jagbandhuji?
Yes, sir.
Is it called efficient frontier or efficiency? Because in some books, I think it is mentioned as an efficient frontier.
It's both ways, efficiency frontier or efficient
frontier. Okay.
Both of them are acceptable. Okay. So this is the efficiency frontier or efficient frontier that we say, which is a set of all your efficient securities and portfolios. Now the question arises, sir, what if I get a security, which is not efficient? For example, let's say you have got a security which is somewhere, lying over here with a risk of 12% and a return of 13.2. Will you call this security to be efficient or inefficient? Of course, it is inefficient, right? Looking at the graph, we have observed it in the last class also. So this particular part over here, the security that we observe here, 12% risk and 13.2% return, it is obviously inefficient. So now what should this security be like? Obviously no one would be interested in investing in this security, right? So what would happen to the prices of these securities, guys? A security which is offering you, let's say, 12% risk and 13.2% return, what do you expect to be happening with the securities? No one is going to buy it, right? So the demand is obviously going to be down, and as the demand goes down, the price of the security, the current market price of the security, will move down. As the price of security moves down, the expected return from the security, if I talk of the expected return from the security, what will happen to the expected return from the security? What will happen to the expected return from the security? Can I say it will go up? Because whatever we are putting up over here, this is a set of your return, expected return vis-a-vis the standard deviation of the risk, right? So this particular security will have no demand in the market. The price will go down. As the price goes down, what will happen to the expected return? As the price goes down, the expected return is going to move up. Like for example, we say the expected price of the security in the next year was, let's say, 12. Current market price that was being offered was 10 rupees. So if I ask you what was the expected return, can I say it is 12 minus 10 upon 10, which is 20%. Okay. Now, if we see that the price is moving down from 10 to, let's say, current market price due to shortage of demand in the current market scenario, it falls to, let's say, 8 rupees. Now, what will be your expected return? So your price is, expected price in the next year is remaining 12 minus 8 upon 8. So you can say it is 4 out of 8, which is 50%, right? Or you can understand it in this way also, like there is no demand for the security in the current market scenario, right? But the business of the company is not getting affected because there's no demand for your securities. So business is going to generate the same return as it was supposed to be doing earlier, right? So your EPS, your earnings per share or the dividend per share is likely to be remaining same, but you are able to get the share price at a lower price. So what is going to happen to the expected return? The expected return is definitely going to go up, right? For example, the original dividend that you were expecting was 5 rupees. Current market price when it was, let's say, 20. Yeah. So let's say current market price was 20. Then our expected return, considering dividend to be our source of return, it will be obviously 5 out of 20, which is 25%. Right? Now, if the dividend remains the same, but the price is, share is available at a cheaper rate. So let's say it is available at 15. So because of the price going down, the share is available at 15 rupees. So we say that expected return now from the security will be 5 out of 15. That is like a 33% is the expected return. So as the price goes down, because the security is, inefficient, because the security is inefficient, as the price goes down, the expected return from the security goes up. So what will happen to this particular security, which is which is standing over here? So the security is going to move up. This security will actually move up to the point that it reaches the efficiency frontier, or the price will be, going down to such an extent till it matches the return of the risk and return profile of the efficiency frontier. Okay, so any security which is inefficient will be, priced downwards, and that will obviously raise the expected return. Okay, same way, if there is some security, possibly over here, which is, more efficient than the existing efficiency frontier, what would you expect this to be happening? What would you expect this security to be? What fundamental would you be thinking about this particular security? Of course, it's offering you a greater return, as compared to the efficiency frontier. So there will be a higher demand. There will be a higher demand for this security. And as there is a higher demand for this security, the price will rise. Now, as the price rises, you need to pay higher amount for this security. And as you need to pay a higher amount, your expected return will go down. And maybe people from the people from this efficient frontier, the investors who are there on the efficient frontier, they will start selling their securities and start moving towards this security. So there will be a merger of, again, this particular security expected return coming down because of the greater demand and the higher prices. So over a period of time, what we'll observe is the market will adjust itself to the efficiency frontier. So there won't be any security which is having, a greater return than the efficiency frontier, and you won't be able to find any security which is, offering you an expected return of lesser than the efficiency frontier, because it has to merge. The demand and supply has to merge to maintain a standard efficiency frontier that we observe. Okay. Now, this is what Markowitz has stated, and it has said to be observing in the market over a period of time. So, like this theory is like almost it's like more than 50 years, more than half a century, more than half a century old theory. But still, it's called as modern portfolio theory because this is the base on which subsequent models are actually built, right? So this was one side of Markowitz portfolio theory, which stated what is available in the market. What is available in the market as far as the efficiency frontier is concerned with regards to risk and return. So with regards to expected risk and return, what is available in the market, that's what is first stated in its first paper by the Markowitz. Now, this was taken to the flip side, to the other side now. Markowitz stated that this is what is observed in the market. Okay, this is what is properly observed in the market, where we find that efficiency frontier is getting created, and investors are looking for the best portfolio. The demand and supply is playing a role to adjust it to the efficiency frontier. Now, Markowitz shifts the focus towards the investor, right? Now, when it shifts to the investor's point of view, so investors' point of view, okay, investors' point of view. Now, the basic question which Markowitz asks is, why would any investor really enter the market? What is the reason that an investor is entering the market with its money? What is the purpose? Can you tell me, guys? What is the purpose for which an investor would enter the market?
Returns.
Returns. Okay. Need not be returns. Markowitz gives it in a very economic sense. It connects it with your something called as what you might have already learned in your school and college days. Have you heard something called as the chapter of utility in economics by, I think, John Maynard Keynes? John Maynard Keynes. Have you heard something called as utility theory? Yes. Okay. So Markowitz connects the reason why investor is looking for investment with the utility. Okay. Now, what does Markowitz really say about the utility part of it? Markowitz states an investor enters the market with an objective to attain utility. Now, in simple sense, when we say why would an investor enter the market? Because investor wants to have utility, or investor wants to attain some level of happiness. Okay, investor wants to attain some level of happiness, and that's what is stated to be utility. Now, just think of a point like, why would an investor, or how would an investor get happiness? There are two aspects. One is, as the expected return rises, what do you think about the happiness of the investor? Happiness of the investor, will it increase or decrease? As the expected return from a security increases, the happiness of the investor is definitely going to increase. But you cannot overlook the risk that that a particular security is having. Okay, the risk that a particular security is having, you cannot overlook that part. Okay. So therefore, investor's point of view, it says the investor utility that an investor is going to get depends on two aspects. Okay. So utility that an investor is going to get is stated to be a function of, it's a function of two things, or rather it's a function of three things which Markowitz has stated. It's a function of your expected return, then it's a function of the risk that a security have, which is the standard deviation also, you can say, and it is also something called as aversion factor, and it's also a function of something called as aversion factor. Now, what is this aversion factor? Let's first discuss that, and then we'll take up this utility for further discussion. Markowitz says that there are three types of investors, which you will observe in the market. 3 types of investors. Not only in the market, you will find these 3 types of people in our day-to-day life also. Okay. So there is someone who is a risk lover. There is someone who is a risk, neutral. And there is someone who is a risk averse. So 3 types of investors, or 3 mentalities of investors is what we can observe. It can be a risk lover, risk neutral, or it can be a risk averse. Now, what do we really mean by risk lover and risk neutral and risk averse? See, these type of investors, the risk lovers, they are the ones who are, interested in just investing in those securities which are risky, or this risk lover always prefers to invest in risky assets, irrespective of expected return. Okay, so this type of investors, are the ones who prefer to invest in risky assets, irrespective of whatever be the level of, expected return of that security. Because they get that thrill, they have that thrill that we want to take the risk, we want to, enjoy the movements of the market, right? This type of people you will find in our day-to-day lives also, right? Some people, they perform bungee jumping, they jump off from the, flying flights, right? What do you call that game, which they jump from directly the flights of, from a greater height. Some of them love mountaineering. So these are the people who love to take risk, right? Now, for some people, it may be seeming to be, foolishness to do things, but then they get that thrill out of it, right? So those are the category of investors that you may find in the market, which are risk lovers who prefer to take greater amount of risk. Markovitch states, my theory is not for these people. My theory is not for these people. Okay, then it says, what is risk neutral, sir? Okay, now this risk neutral category, again, it's a type of, type of investor where these investors prefer to invest in assets which have higher expected returns. They prefer to invest in those securities where you're likely to get a higher expected return. Now, what's wrong in that, sir? Because they are obviously going to invest in those securities which are having higher expected return, but the problem is they are not giving any consideration irrespective of risk in the asset, right? So if you are like someone who is only looking for assets which are promising you a higher expected return and you invest money in there without looking at the risk involved in it, you are into the risk neutral category because risk doesn't affect your decision. So as an investor, for you, what matters is only the returns. Now, do you think this is something called as a rational approach? Do you think purely investing on the basis of, purely investing on the basis of return, does it make sense? Does it make, a rational decision? No, you need to give due consideration to the risk also. So only person who takes investment on the basis of risk or on the basis of return is not at all acceptable by Markovitch. Markovitch says my theory is not for these two people. My theory is for the rational set of people who are, risk averse. Now, what do you mean by risk averse? What do you mean by risk averse? Risk averse means we are, afraid of taking risk. But if you give us, some sort of higher expected return, then we are ready to take the risk. So risk averse are basically investment is made in risky assets only if adequately compensated, with higher expected return. So these are, rational people who are saying that we are ready to invest in a risky asset, provided we are, likely to get a return which is, higher as compared to any other asset. Now, what do you mean by this adequately compensated? Every person is having a different degree of aversion. Every person is having a, different degree of aversion, because every person has got their own mindset regarding the risk. Someone may be, very much aggressive, someone may be very much conservative. Now, for example, we may look at, let's say, there's a standard deviation of, let's say, 12%, and you have a expected return of, let's say, 15%. Right? Someone may say, okay, this for a standard deviation of 12%, expected return of 15% is okay for me, I'm ready to invest. But there may be someone, who would be like, I don't want this, I'm not going to invest at this 15%, because for me, 15% is not going to be adequately compensated. So I may be requiring a higher rate of return, maybe 17%. So every person is having a different degree of aversion, guys. Every investor has got a different degree of aversion, and that aversion is, individual specific. Every individual has its own set of preferences. Someone would like to take a greater degree of risk, someone would like to take a lower degree of risk. So therefore, you will find the types of investors with, multiple levels of risk aversion. So for example, if I ask you, let me just draw a chart and check whether you are able to follow or not. Oh, this is so weird. We have a, let's say, yeah. So there are two, what we call investors over here. There is one X and one Y. On X-axis, we have risk, and on Y-axis, we have return. Now tell me, out of X and Y, which one is a conservative investor and which one is an aggressive investor? Because this line indicates what is the return they require for a given level of risk. What is the return they require for a given level of risk? What do you think? Which one of these two, X or Y, which one is an aggressive investor and which one is a conservative investor? Which one is an aggressive, which one is a conservative? Tell me, guys. Which one is aggressive and which one is conservative? If you think, like, from the point of view of both, for a given level of risk, for this level of risk, Y, requires R1 return. Whereas for the same risk, X requires R2 return, right? So for the same level of risk, Y is requiring a lesser return, whereas X is requiring a greater return. So who is conservative and who is aggressive? For a same level of risk, if you require lower return, it means you are aggressive. For a given level of risk, you require a lesser return, it means you are aggressive in investment. You are ready to invest anytime, quickly. But if you are someone, who is very rigid, that, okay, this level of risk, I'm not ready to invest for a return of R1, I want a higher return. So I am very conservative. I'm very much afraid about taking risk. I'll be investing in this particular security or in this particular option only if, I'm being offered a higher rate of return. So of course, out of X and Y, the person X that we observe over here is said to be a conservative investor. Okay. And whereas this is an aggressive investor. When you say aggressive means what? I'm ready to invest it quickly. I'm ready to invest in the security easily for a given level of risk and return. But if there is someone, who wants to really think of, I want to maybe a higher rate of return to invest, then you are said to be a conservative investor. Okay. Now this, your aggression or your conservativeness of a return, it actually depends on your risk aversion. It depends on your risk aversion. Okay. Sumit, high risk, high return it's not in that way. I think you missed the previous part, what I was saying. X is conservative because for the same level of risk, X requires a higher return. So it's not very easy to convince Mr. X to invest in the securities. Right? You say, we are from a very conservative family. So it means what? It's difficult for your family members. It's difficult for you to convince your family members on something. Right? So same goes with the investor also. When our investors are, conservative, you need to actually offer them a higher rate of return. You need to offer them a higher rate of return to get them convinced to buy the securities. Okay, got it? Okay, fine. So this aversion factor also plays a role in deciding the utility of an investor. Okay, guys. So utility of the investor depends on three factors. One is the expected return, second is the risk, and third is the aversion factor. Now, with the expected return, of course, utility of the investor will increase. Due to the expected return, utility of the investor will definitely increase. What will happen to the observed risk in the security? Due to the observed risk in the security, utility of the investors will decrease. Utility of the investor will decrease. Whereas, due to aversion factor, the utility is again going to decrease. If you're more conservative, you will see the risk to be, something more for you. So let me just put up a formula over here, which Markowitz has given regarding the utility. The utility of an investor is stated to be expected return minus 0.5 into aversion factor into variance of the security. Okay, that's the formula which has been given by Markowitz, because it states that expected return, is something that is, going to provide happiness to our investors, right? Whereas the other portion, which is the variance is nothing but the square of the standard deviation, right? So that particular portion, which is the variance and the aversion factor, that is going to provide some sort of unhappiness to the investors, and an investor would definitely be interested in maximizing the utility, right? So maximizing the utility. So my investor would be, something who would be obviously looking for maximizing the expected return and also trying to minimize the aversion factor and the variance. Now this aversion factor is multiplied with the variance to give the magnification effect. Okay, to give the magnification effect for the investor. Generally, the value of A, aversion factor, which is A, it ranges between, 1 to 5. So aversion factor generally ranges between 1 to 5. So how do you determine this aversion factor? How will we get to know, how much our prospective investor is, averse? What is his aversion factor? How much he is averse? How are we going to determine that? So there is a proper, questionnaire which is recommended by Markowitz, which I'm not going to discuss about that, but I'm just giving an idea where, you ask the investors, you give a scenario to the investor, and you ask the investor to pick the appropriate option. Like you might have got some questionnaires in the form like, how likely are you, to recommend our services to your relatives? And then you have got that options, very highly likely, or, much likely, neutral, strongly disagree, or disagree. So some sort of, Likert scale. That's called as a Likert scale, right? So have we, ever got this sort of questionnaire when you are, generally in the feedback forms and all, you get this type of questionnaires, right? So have you ever encountered such sort of questionnaires where they ask you to, fill up like agree or strongly agree, neutral, disagree, strongly disagree, right? So that Likert scale, a questionnaire is given to the investor. Investor is supposed to fill out those points, and obviously the final net outcome of all those questionnaire will be the aversion factor that an investor has got. Okay. Now, of course, if an investor is having an aversion factor of 5, that means the investor is very much risk averse. And if the investor is getting an aversion factor, lower, is lesser risk averse. Now, of course, higher the aversion factor means the investor is more conservative. Higher the aversion factor, the investor is more conservative. Lesser the aversion factor, the investor is lesser conservative. Or you can say the investor is aggressive. Okay, so this is what we get as the happiness or the utility that an investor gets from the market. So when we try to look at what an investor requires this term, which is expected return minus half into aversion factor into variance. This is what the investor requires, and obviously the investor would be obviously trying to maximize the utility, right? So I, as an investor, enter the market with a bag full of money. Let's say I've got, 1 crore rupee to invest in the market. I would be obviously trying to look for the best opportunities for me, which will be maximizing the utility. So what we observe is, as an investor, I enter the market with my degree of utility, maximization of utility being my objective. So I found that this is like, let's say, risk-free rate, and my rate of return is this one. This is what I expect in the market, the utility curve. Okay, with first utility curve U1, I enter the market. I strongly spell out my decisions that for a given level of risk, what is the return I get? Because this is of course 0. So this particular point is the risk-free rate. This particular point that we see is the risk-free rate, because at 0 risk, you are getting a risk-free rate. So as the risk increases, we expect a higher level of return, and therefore this is what my requirement is. But is the investment going to be made only on the basis of my own investment, or only on the basis of my requirement? Like I spell out that for this level of risk, I want this level of return. Can I just do that, based on my own expectation, based on my own requirement? Can I make an investment in this way? Can we make an investment just on our expectation? Or do we need to look at the other parties or the other side of market also, right? So when we look at the market on the other side, we find that, this is what the market is. So this is what our efficiency frontier is. Now, looking at this utility curve, this is what the investor want. This is what is being offered in the market. Can the investor make any investment in the market? Can the investor make any investment in the market? Yes. Yes. Can the investor make an investment in the market? Efficiency frontier is here. Utility curve is, far from it. So will the investment be made by the investor in the market? Will any investment be made in the market? Yes or no? Is there any matching risk and return profile of any security or portfolio with the investor? No, sir.
No, sir.
There is no investor. There is no possibility that investor will find any security in the market. So what should happen? What should be the next thing then? Can I say we always enter any market? We enter any market with a greater expectation. But when reality hits us, then we start changing our expectation, right? Correct? So when we enter any market to buy a commodity, or even in our real life situation, whenever we try to interact with people, with particular aspect, we may not be getting people, we may not be getting the securities, or we may not be getting the products which match our expectations. So ultimately, what we have to do, what are we supposed to be doing? We need to lower our expectations, right? Because unless and until you lower the expectations, you can't be, just investing in the market. So as an investor, you need to maybe lower your utility curve. The next utility curve which you will possibly have is, maybe you'll say, let's do some compromise and try to go for a lower utility level. Now at second utility level also you don't find any security. Then you go for further adjustment in your utility, and you find as you lower your utility, now we have got a tangency point over here, right? This tangency point, let me name that as portfolio or security X. So that tangency point is somewhere the investor's utility is matching with what is available in the market, right? So the interaction of the entire market force and the investor's expectation is going to match by this tangency point. And this particular portfolio will be offered to the investor that, see, based on your utility, based on the expectation, and based on the aversion factor of yours, this is what we can offer to you for your maximization of utility. Now, of course, you will not be going beyond this. Like you will not be reducing the utility to U4. You won't be reducing it to utility 4. Okay, because of course at utility 4 also you can get these two securities, which is at the intersection. But of course U3 gives you a higher level of utility. The higher utility curve is providing you a greater degree of utility, and therefore you'll be obviously settling for the portfolio X. So the security or portfolio that will be offered to the investor, portfolio offered to investor is going to be the portfolio X, which is the tangent, point of tangency, rather we can say, which is the point of tangency. Okay, so that's what we meant by the portfolio theory, modern portfolio theory, which was proposed by the Harry Markowitz, for which he has even got the Nobel Prize. Okay, so quite intuitive. Just think of this theory being developed, 50 years ago, not even 50 years, because we are in 2024. This is a portfolio theory belonging to 1950s, almost 75 years ago. This concept was, this particular thing was conceptualized, and where for the very first time in the finance domain, something like portfolio optimization, or what should be offered to the investor, was decided. And this theory was prominently used for, as it was invented, this theory was prominently used for investment management of the clients by the bankers of that time, prominently used for almost for a couple of decades. For the next 20 years there was total reliance on this particular portfolio, this particular methodology to offer investment to the clients. Okay, so this is what Markowitz's portfolio theory was regarding how an investor is going to choose the securities. Okay, is this point clear? Is this concept clear, guys? Markowitz's modern portfolio theory. Yes. Are we good with this modern portfolio theory? Great. Now let's take it forward. Let's take it forward for our further discussion. This Markowitz was obviously was prominently used for discussion, but then this theory developed further because there was some gap, some concept which was some concept or something which was not covered over here. So it was developed over a period of time. So this was the first theory that we had. Now the next question was asked, sir, how do you calculate what is the required return? Because when we started with the portfolio theory, my introduction part, I said that this chapter is going to tell us how much return our investor is going to require. How much return an investor is going to require. So Markowitz answered it for the first time by giving the utility theory, and we can just change it, or we can just reverse this particular equation to arrive at what is the expected return of a shareholder. So what is the expected return of an investor? That depends on what sort of utility you want, you can just rearrange this. Utility plus half into aversion factor into variance of the security, right? So this is the expected return value, which was conceptualized by Markowitz in its modern portfolio theory, which further paved way for other aspects. Okay. Now, let's go for the next concept based on this Markowitz modern portfolio theory, which is simply called as capital allocation line. Okay, capital allocation line. Now, what do we really mean by this capital allocation line? So for that, again, I'll just, take this particular data for discussing what is capital allocation line. Okay, so we know what is a efficiency frontier now. So let me just delete this portion so that we'll be in a position to discuss the next concept, which is capital allocation line. Okay, so as we have stated that this is going to be our efficiency frontier, and we won't find any security which is, more efficient than this or less efficient than this. So in the market, we will obviously observing this sort of returns, correct? Now, when we are looking at these particular numbers, let me just take it over here, like portfolio 5 onwards. Let me add few more portfolios to make this even more interesting. This is linked. So some portfolio A, B, C, D. Right, so I'm just adding few more combinations so that we'll be able to visualize the other aspects. So it's like 0.65, 0.60, 0.55, 0.52. So I can just get this weightages, right? And let me just put up over here the numbers. So this particular standard deviation and number, I'm just putting it in more detail because I need the proper graph for easier understanding. Okay, so this is the efficiency frontier that we have observed in the market. One thing which was missing in the Markowitz portfolio theory was consideration of risk-free asset also being available for investment in the market. If you look at this efficiency frontier, do you find any of these securities being risk-free? In the efficiency frontier, do you find any security being a risk-free security? No, because the risk is, the minimum risk that you're stocking is 8.65, and beyond that, it's just increasing. So there is no consideration given over here for the risk-free security. So don't you think an investor would be obviously having an option to invest in risk-free security? Yes or no, guys? Don't you think an investor would be having an option to invest in a risk-free security?
Yes.
Yes.
Generally, government securities.
Yes. So generally, we can say government securities are definitely available for investment. Now, this is what is available in the market for other securities. An investor will definitely have an option of risk-free security. Okay, so let us consider an option that investor has got of investing in a risk-free security. If an investor has got option to invest in risk-free security, where would the risk-free security be lying? Where do you think on this particular graph the risk-free security would be lying? Yeah. Where do you think the risk-free security should be lying? Can I say it will be lying on the y-axis? Right? It will be lying on the y-axis. Correct, guys? Because on the y-axis itself, the risk is zero, the standard deviation is zero. So our risk-free security would be definitely lying somewhere over here. So for our understanding, let us consider the risk-free security is, offering us, suppose 12.6%, or maybe, yeah, let us say that this is the risk-free security option available with us, which is offering us some 12.6%. So let us assume that this is the risk-free security that we have. Now, a person who is, totally risk averse, who doesn't want to invest in a security, he will be obviously sitting on the risk-free security. But if I give an option to our investors that, okay, you can combine risk-free security with any of these portfolios. So won't you really be knowing what will happen if I combine risk-free security with any of these portfolios? Won't you be exploring what is the risk and return of my profile if I'm going to combine risk-free security with any of these, portfolios or any of these securities? So what would be the situation? Like if I want to combine the risk-free security with the first portfolio, which is the portfolio 5 or portfolio V. I can combine it with A, I can combine it with B, I can combine it with C, I can combine it with D, I can combine it with 6, 7, 8, 9, 10, any of them. I can combine with any of the portfolios, guys. So what would happen? What will be the risk and return profile of the new portfolio? So new portfolio that we are talking of, comprising of risk-free asset, and the new portfolio comprising of risk-free asset and security from efficiency frontier. How would this particular risk and return profile look like? So Markowitz, again, this theory was further developed by Markowitz itself. So it stated that if you're thinking of combining, a portfolio with the risk-free security, okay, and if you think that let me combine it with, the lowest one, so this is what the graph will really look like. So if you're going to combine risk-free with the first security, the graph will look like this. And if you want to go for, higher level of investment, like let us look for, what can we really do if I'm going to combine the risk-free security with some other securities on the efficiency frontier. So the new line, the second line, when you're going to go combine it for higher level, this will look somewhat like this. Then if you want to combine it with, even more greater degrees, we can just keep on combining it with, as we move along the efficiency frontier, we can definitely choose varying degrees of combination with risk-free. Like this is what, suppose this particular line that we say, this particular line is a combination of risk-free plus maybe portfolio 5. Then the green line that we observe, it's a risk-free plus A. The magenta line or the dark pink line that we observe, it may be risk-free plus B. Same way, risk-free plus C, risk-free plus D, risk-free plus. You can combine risk-free with any of the portfolios or securities lying on the efficiency frontier. Okay, so that efficiency frontier is, getting combination with risk-free opens up a altogether new idea of investment. Like, just think of it. Is it better to invest in this portfolio 5, which is lying over here at the lowest part of the efficiency frontier, or would you really like to prefer to invest on a parallel, perpendicular position upside over here? So let me just name over here. This is maybe 5. This is maybe A. This one is maybe B, right? So would you like to be invested in this portfolio of portfolio number 5, or would you like to, take it a bit upside and, make an investment over here? What would you prefer? Would you like to invest in this portfolio 5, or would you like to combine risk-free and the security B? Would you like to invest in 5 or invest in a combination of risk-free and B? Of course, you will be investing in a combination of risk-free and B, because the proper combination of risk-free and the security B will give you a higher return. It will give you a higher return, right? It will give you a higher return as compared to this portfolio V at the same level of risk. Am I right, guys? Correct? So you'll be getting a higher rate of return if you're investing in combination of B and risk-free as compared to the portfolio number 5. So we'll try to say, okay, sir, at a particular level, if you observe that we are getting a higher level of, return at the same level of risk, let's try to combine even more securities with risk-free, and let us observe that which is the best thing that we can get. Now, can I say this particular portion from the chart, that is from portfolio 5 to B, this particular portion becomes now inefficient because you have this new efficiency frontier or new combination coming up in the market due to consideration of risk-free and this other securities being combined together. Okay, so if I just look for what is the best possibility for us to combine, say, so if I just think of, I can just move up and up, right? So now this particular line that we have over here, this particular line that we have over here is obviously better than the entire efficiency frontier. Now let me say that this efficiency frontier, this is better than the entire efficiency frontier that we have, or the point of tangency which we observe, we can combine risk-free along with, some point of tangency, and this is the best efficiency frontier now you can get. So now what is happening to your efficiency frontier? The efficiency frontier which was there, that efficiency frontier is essentially becoming, can I say, inefficient now? The efficiency frontier is essentially becoming now inefficient, right? Am I right, guys? Because no one would be interested in investing just any of these securities, because I would like to combine one of the securities with the risk-free, because that gives me a better sense of, that gives me a better idea about how the return can be maximized for the given level of risk. Now just think of a point of view, the investor who is sitting over here in the portfolio V, of course he or she would be invested in shifting to this point. The person who is sitting at B, he would be interested to shifting over here. The person who is sitting over here, he would be interested in shifting over here. So the new option that we have of combining the risk-free with the security in the efficiency frontier opens up a new area of area in which the investment can be made, and that gives us a line which is better than the efficiency frontier. And this particular line is what we call as the capital allocation line. So what's the capital allocation line? Capital allocation line is the line of tangency between efficiency frontier and risk-free security. Okay, so capital allocation line is basically the line of tangency between
Sir, is
The
that
efficiency
chart
frontier.
not reverse? Sir, return is actually at the same place, but risk is increasing. Is that x-axis and y-axis we have to change for this graph?
Sorry, Anila?
Sir, that return is on the same 8 point something, means year by 9, but we are going up and increasing the risk. Maybe the x and y to change?
No, the y-axis is denoted by return. So as you move up, the return is increasing. Risk is constant.
Okay.
Okay,
Because it was written in downside. No, I thought exactly.
No. It's the line indicating the return. So this efficiency frontier that we had, that was return.
Okay.
Okay, on x-axis we have the risk. On y-axis there is a return. So the investor who is sitting at 0.5, if he shifts to the upper side with the same level of risk, he's going to get a higher return. Okay. So capital allocation line is this particular line, which is the point of tangency, or which is the line of tangency between efficiency frontier and the risk-free security. So now can I say this capital allocation line is the new efficiency frontier, because the old efficiency frontier which we are talking of, without taking into account the risk-free security, that is redundant. Now this is a new efficiency frontier. So as you identify that there is a new efficiency frontier, what is going to happen, guys? What's going to happen? Like this was our efficiency frontier. Okay. And let's say this is the point of tangency that we have. Yeah, this is a point of tangency that we have. So all those investors who were sitting over here, or maybe here, or maybe here, yeah, maybe over here, all those investors who are sitting on this particular position, what are they really going to do? What are they really going to do, guys? Can I say these investors will slowly and steadily shift upward? Right? So our investors are going to shift upward. So the person who was sitting over here is going to shift over here. This one is going to shift over here. The person who was sitting over here is going to shift up. So entire set of investors will be shifting on the capital allocation line. Now, can I say, if the entire set of investors or all the securities that were there on the efficiency frontier, as they shift upwards, because the demand for the individual securities won't be there. So as the demand for individual securities is not there, the prices will go down, expected return will increase. So the securities will move on the upside. As the securities return move on the upside, what do you think? Will you find this curved efficiency frontier in the market? Will you be able to find this curved efficiency frontier in the market? Yes or no?
No, sir.
No, it will get eliminated, right? So now, once the capital allocation line is identified, all the investors will shift from capital allocation, will shift from efficiency frontier to the capital allocation line. So as they shift to capital allocation line, the resultant impact would be, what will be the resultant impact, guys? Can I say this entire curved portion will get eliminated, and you will have only a single line, which will be the line between the risk-free and maybe the entire market over here, RM. Right? So this now, when the entire market shifts to this particular line, that becomes something called as capital market line. So what is capital market line? The line formed when all investors or all securities shift from efficiency frontier to capital allocation line. So now this particular line is said to be the capital market line, because entire market sits over here. Right? So for example, if you are someone who don't want to take risk, you invest over here. If you're someone who wants to take the risk as what we have in general in the overall market, the risk that you have in the overall market, if you want to undertake that risk, then sit over here. The average, if you want to take the average risk of the market. And if you're someone, who want to take a risk lesser than the market, who wants to take a risk lesser than the market, you sit somewhere over here. And if you want to take risk more than the market, you can go beyond that and maybe sit over here. So this entire market is placed over here, and you know that average market is sitting over here. If you want risk, if you want to bear a risk lesser than market, stay below that. If you want to take risk more than market, go above that. Right? Okay, so this is what we mean by capital market line. Now let me just try to form a equation for this capital market line by creating something, equation form. So suppose now our portfolio comprise of risk-free asset and market. So our portfolio comprise of, let's say, risk-free asset and the position and the security placed, the market placed over here, which is RM. Let's say we are giving weight of risk-free asset to be WF. Okay, and we are giving like weight of market to be denoted by WM. Okay, and we obviously know that weight of risk-free can be 1 minus weight of the market, and weight of market can be 1 minus weight of risk-free. Now, one thing that I can really think of over here is, what will be the risk of portfolio? Obviously, we're going to refer the Markowitz portfolio. What will be the risk of portfolio? So let's say standard deviation of market. Standard deviation of market is going to be denoted as, let's say, sigma m. Standard deviation of market is going to be denoted by, let's say, sigma m. Standard deviation of market is going to be denoted as, let's say, standard deviation of market. Can you tell me what will be standard deviation of the risk-free security? What can you say about standard deviation of risk-free security? 0. Absolutely.
0, yes.
Right? So standard deviation of risk-free security is 0. See, if I have a portfolio comprising of a risk-free security and a security from the market, what will be the standard deviation of portfolio? What will be the standard deviation of my portfolio? It will be square root of weight of risk-free. It will be square root of weight of risk-free into 0, or weight of risk-free square into 0 square, plus weight of market square into standard deviation of market square, plus 2 into weight of risk-free, weight of market, 0 into standard deviation of market into correlation between market and risk-free. Now, out of this, obviously, this particular portion and this particular portion will become 0. So what will be left out? Standard deviation of our portfolio. So how do we write down the standard deviation of our portfolio? Standard deviation of our portfolio will be simply, can I say, weight of market into standard deviation of market, guys? Right? Because square root, so weight of market into standard deviation of market. From this, we can obviously derive and say that weight of market is standard deviation of portfolio upon standard deviation of market. Okay, so let's just keep this in mind. And now think of what would be the return of our portfolio. What could be the return of our portfolio now, guys? Return of portfolio return of our portfolio will be weight of risk-free into return of risk-free plus weight of market into return of market, right? So now my portfolio, since it comprises of my risk-free security and the overall market portfolio that we have, I can say weight of risk-free also as what? 1 minus weight of market into risk-free plus weight of market into return of market. So if we just simplify it, we'll say risk-free minus weight of market into risk-free plus weight of market into return of market. Then this will be like risk-free. I can take common here. We can take like plus weight of market common. So inside what we will have is return of market minus risk-free. Now what was the weight of market formula? Weight of market formula is this, right? So I can just substitute that in place of weight of market, it will be standard deviation of portfolio upon standard deviation of market into RM minus RF. So this is the return that we would expect from our portfolio. Yeah. Yeah, Brakesh. Yeah, some query?
Sir, in case of standard deviation of portfolio, just go upside. But sir.
Yeah.
Now, earlier the formula was under root, and then you have removed the multiply with multiply 0. So standard deviation of portfolio is equal to WM into standard deviation of M, or where is the effect of under root is there? It's now without under root.
No, this is with under root because you have weight square, right? In the formula, you have weight square of market, and WM square and
square. Okay.
Square
Everything is square. Okay.
So that square is get removed.
Okay, thank you.
Okay. Yeah. So we get the return of portfolio equal to RF plus standard deviation of portfolio divided by standard deviation of market into RM minus RF. Does it seem similar to something? Does it look similar to something that you had learned in your CA Inter? RF plus something into RM minus RF. Does it seem similar to KPM model? Yes. Okay. But hold on. This is not KPM. And standard deviation of portfolio upon standard deviation of market is also not your beta. This is not beta. This is one step before beta was used. This is one step before beta was used. This is not beta. We'll do the beta in the next stage. But this is the capital market line approach. This is the capital market line that is used, and it's not the CAPM model. Okay, so the idea or the concept is pretty simple over here. You have the risk-free security. You need that bare minimum return plus the risk premium, you can say. So conceptually, we can understand this as this is your risk-free return. And this portion is the risk premium. This particular portion is indicating the risk premium that you as an investor will be earning. Okay. Are we good, everyone? Yeah. So this is the what we have done, Markowitz portfolio. Then we improved upon it by taking capital allocation line. Then we said that everything is going to move to the capital market line. So that's where we say that this is going to be the equation. Now we have to discuss the next part, which is called as the capital, an improvement over capital market line is called as securities market line, SML, securities market line, or what we call it as CAPM or capital asset pricing model. 1 second of this. securities market line or capital asset pricing model is what we are going to cover now. The capital market line that we had, which was simply giving us a model of asking for the expected return to be based on the risk-free security plus the risk premium that we want, plus the risk premium, which is standard deviation of portfolio upon standard deviation of market, multiplied by RM minus RF. Right? If you understand it logically, it's pretty simple that this RM minus RF is the risk premium of the entire market. Compared to the market, how risky my portfolio is. That was taken as standard deviation of portfolio upon standard deviation of market. And this entire portion is what we call as the risk premium that we expect as per the capital market line. But securities market line, it lays certain foundational assumption when we are trying to calculate the required return from a security. Okay. It says, as the time has evolved, like this particular model, which was given by Sharp, William Sharp. Okay. He again developed another model also. So this particular model, which is developed by William Sharp, it stated that as we have developed, since the time the Markowitz portfolio theory was developed, and we have come a long way. Like this theory was almost what? It belongs to the ages of 1970s, right? Maybe half a century old. Okay. So as the markets have developed, this particular Sharp model, it stated that an investor, a rational and efficient investor, will never be invested in a single security. Am I right, guys? Will you as an investor stay invested in just one security? Or would you like to create a portfolio of security? So it stated that with the advent of new companies coming in the market, an investor will never be invested in just one single security. Rather, the investor would be, putting his money into multiple securities, right? And what do you think as you, keep more securities? What is going to happen to your risk? What's going to happen to the risk of the portfolio? If you keep adding,
it will reduce some extent.
It will reduce, right? So overall portfolio risk is going to get reduced because of the diversification benefits, right? For example, if I'm just invested in, let's say, Adani Enterprises, so I'm exposed to greater level of risk. Same will be the case if you're just invested in, let's say, shares of SBI or maybe shares of Coal India Limited. So if you're invested in just one single security, you know what, you will be, just focusing yourself to or exposing yourself to a greater degree of risk. Rather than that, if you combine more number of securities into your portfolio, your risk is definitely going to reduce. Like you're invested, you have created a portfolio comprising of Infosys, your TCS, your SBI, Coal India, L&T, Adani, Reliance Industries Limited, maybe some other mid-cap stocks, some other small-cap stocks. You invest it fully. You're going to optimize your portfolio by including more and more securities into your portfolio. So as you bring in more and more securities into your portfolio, the risk is going to get reduced. But the question arises, can we reduce the risk to zero? Can you reduce the risk to zero, guys? No, it's not possible. So it says that, well, when you are going to create a portfolio of security, you will definitely have a diversification benefit, right? So if I say that on x-axis, this is number of securities, and on y-axis, we are plotting, let's say, risk. So as we are going to combine with, securities, the risk is going to get reduced, but it will never be zero. But the risk is never ever going to be zero. The risk is never ever going to be zero, guys. Why do you think that risk is never going to be zero? Let's say I invest in all the securities which are available in the market. Will my risk be zero? No. Why do you think the risk won't be zero?
No, because all the securities have a mix of movement. So all are not in same direction. So because of that, it's never going to be zero.
Okay. You know what? Sharp simply stated that you cannot reduce the portfolio risk to zero because your portfolio is exposed to certain risk which is beyond your control. Your portfolio is exposed to certain risk which is beyond your control. Okay, that is not within your control. So you are exposed to that particular risk. So in the entire market, even if you are invested in the entire market, you will be exposed to something called as systematic risk. The risk that arises from the system. The risk that arises from the overall macroeconomic system. So the macroeconomic system is going to have an impact on the entire market, right? So what could be the macroeconomic impact? It could be the GDP growth rates. It could be the RBI setting higher repo rates. It could be the adverse fluctuation in the forex rates. So whenever these sort of things happen, that there is some macroeconomic risk that you as an investor is facing. So what is happening, sir, when I'm trying to minimize the risk? When you're trying to minimize the risk, you are trying to just minimize the, unsystematic risk. So this particular portion that we have, this was the unsystematic risk, which was, getting minimized. Whereas this portion, which you cannot do away with, is the systematic risk. This is your systematic risk. You cannot do away with that, right? For example, if you just invested in one security and let's say the CEO of that company resigns, obviously the share prices will take a dip. So you are exposed to greater risk. But in comparison to that, if you are invested in that security along with the competitor of that security, right? Along with that, if you are suppose invested in the competitor of that particular company, then if the share price of one security is falling, the share price of other security will go up and your portfolio will maintain an adequate balance, right? So you can minimize or you can reduce the unsystematic risk. You can remove the unsystematic risk, but you cannot do away with the systematic risk. So as an efficient investor, what should be your objective? As an efficient investor, what should be your objective? Should you even try of getting away with the systematic risk? You cannot do away with the systematic risk. You have to expose yourself to systematic risk. But what about the unsystematic risk? So as an efficient investor, as a rational or efficient investor, what would be your objective? Rational investor's objective will be to, what will be the rational investor's objective? Rational investor's objective will be to, can I say, minimize the unsystematic risk, right? Minimize, or if possible, we would obviously, remove the unsystematic risk. We will try to combine portfolios in such a way, we'll try to combine securities in such a way, the unsystematic risk will be done away with, and our portfolio will be exposed to only the systematic risk. Am I right, guys? Our portfolio will be exposed to only the systematic risk portion, right? So now if we talk of risk premium, will the market be available or will the market be ready to give you a risk premium for the total risk that you will be taking? I mean, like, this is the total risk that we have, right? So will the market be ready to give you a risk premium for the total risk or only the systematic risk? Because everyone in the market, everyone who is investing, he is facing some sort of systematic risk. They are not facing any sort of unsystematic risk. So what return should you be expecting? Would you be expecting a risk premium for the total risk or the systematic risk? Will you be asking for a risk premium for total risk or the systematic risk? Of course, the market will be offering you only the systematic risk premium, because if you are not able to optimize your portfolio, you are an inefficient person. If you are an inefficient investor, you will definitely make a loss in the market, because market is ready to give you risk premium only and only for the systematic portion and not for the total portion, because unsystematic risk is something which you can eliminate. So market says, please eliminate that unsystematic risk, because we will be ready to offer you only the systematic risk premium. Okay, so therefore the CAPM model or securities market line model says you will get a risk premium only for the systematic risk. Okay, so CAPM says risk premium will be offered only for the unsystematic risk. Risk premium will be offered only for the unsystematic risk. Sorry, risk premium will be offered only for the systematic risk, because unsystematic risk will be, unsystematic risk will be removed by the diversification, right? Unsystematic risk can be eliminated by diversification. So if you can eliminate the unsystematic risk by diversification, the market is definitely not going to offer you that risk premium. So now it's time for us to redefine the capital market line to securities market line. Let me just redefine it for you. Return of a security as per the capital market line, it was RF plus standard deviation of security upon standard deviation of market into RM minus RF. Right? So return of security is RF plus standard deviation of security upon standard deviation of market into RM minus RF. Now here, if you see, RM minus RF was divided by standard deviation of market. So this was like the risk premium for 1 unit of market risk. And then you multiplied it with the total risk of the security. The SML says that return of security should be risk-free security plus standard deviation of security upon standard deviation of market into RM minus RF. But an additional element needs to be added over here, which is correlation between the security and the market. So we need to add additional element over here, which is correlation between the security and the market, right? This particular portion, this particular part is added, or it's multiplied with the standard deviation of security to adjust the total risk with the systematic risk. Now let us take certain numbers to understand it in a better way. Let's say risk-free risk, sorry, this just went down, crashed. Okay. Let's open it. Okay, so let's take some numbers to understand it in a better way. Suppose risk-free security rate is 6%. Overall market rate of return, the average market rate of return is, let's say, 10%. Standard deviation of our security is, let's say, 15%. Standard deviation of the market is suppose 10%. Okay. Now, as per CML, what will be the risk premium that will be offered to us? As per the CML, the calculation will be like 6% plus 15% divided by 10% multiplied by 10% minus 6%. So what is the value of this? As per CML, what is your required return? Can calculate
12%.
How much?
12%, sir.
12%. Okay. Now the same thing if I do for SML, securities market line, we'll need the correlation. So let's say correlation. Okay. Correlation between the security and the market is, let's say, it is 0.6. So my SML equation will be now 6% plus 15% will be multiplied with 0.6 and then divide by 10%. The whole will be multiplied like 10% minus 6%. So what are we doing? We are, adjusting this 15%, which was standard deviation of the security, with the correlation. So when we say we are adjusting this with correlation, we are trying to multiply this, and we are saying that out of 15% is the total risk. Out of that 0.6 means 60%. So what is 60% of 15%? Can I say that is 9%? So your systematic risk in this security is just 9%. Systematic risk in the security is 9%, and you will get the risk premium only for that systematic portion. So when you're multiplying its correlation over here, you're actually proportionating, you are taking a proportion of the standard deviation of security, which was representing the total risk. So standard deviation of security, which is representing the total risk, that total risk is multiplied with correlation. That total risk is multiplied by correlation to get the proportion of the total risk, which is representing the systematic risk. So now under this, what is the required return?
9.6.
9.6%. So of course you can see, as you are going to get compensated only for the systematic portion, you will be obviously be offered a lower rate of return, because you are going to be offered the risk premium only for the systematic risk proportion. And this particular part that we have over here, this entire portion is what we mean by beta. Okay, so what's the formula for beta, guys? We got a formula for beta. Beta is going to be calculated as correlation between security and market multiplied with standard deviation of security upon standard deviation of market. Now this beta has got some other formula also. Let's have a look at the other formula for beta also. The other formula for beta, we can actually derive it from here. Correlation was actually computed as what? Covariance between security and market upon standard deviation of security and standard deviation of market. This multiplied by standard deviation of security upon standard deviation of market. So we just wrote the correlation formula over here. Can we do some cancellations here? Yes. Standard deviation of security gets cancelled, and we get a formula for beta as what? Covariance between security and market upon standard deviation of market square or variance of market. Okay. We can further expand this and say that this is simply summation of security minus expected return of security into market minus expected return of market upon summation of market minus market expected return of market square, right? If it is based on probability, or obviously there will be a different formula, but you can also expand this and say that it is summation of SM minus, or this is n summation of SM minus summation S into summation M, the whole divided by n summation m square minus summation m the whole square. All these formulas, just getting derived one after the other. If we have a probability based data, then the formula is summation of p into s minus s bar into m minus m bar upon summation of p into m minus m bar square. Okay. So if it's a probability based scenario, we'll need to use this particular formula. But yes, the origin of beta is this correlation between security and market into security, standard deviation of security upon standard deviation of the market. Okay. Right? Have you understood how to calculate the beta, guys? Is the beta calculation clear to everyone? Yep.
Sir, please explain this formulas n into summation s into m.
This is derived. This is derived. If you open this bracket, like s into m, and then s bar will be summation s upon n, m bar will be summation m upon n. So
Yes.
if you solve it and derive it, you'll get this formula.
Okay, sir.
Now we will be using this whenever the s bar, m bar is, whenever these terms are, in decimal. So then it becomes very difficult for us to do the calculation as, taking the difference in decimal, then multiplying it. So when you have the s bar and m bar as decimal, you'll simply go for this formula. So we just need to substitute it, and no subtraction and squaring is taking place.
Okay, sir. Thank you, sir.
Okay. Okay, guys. So since you have understood this beta calculation, let's just take a break now. And after the break, we'll do questions based on this CAPM, CML, and capital allocation line. Okay. So let's take a break, guys. We were doing some of the really fantastic concepts about the capital market line, the securities market line, the calculation of beta. Okay, now let's just try to solve certain numericals based on these concepts, because after this we have like sharp single index model, which will be, and arbitrage pricing theory, which will take it up in the subsequent session. So right now let's just practice few questions based on this concept. Okay, so let's go ahead with question number 8, guys. Let's try to compute this question number 8. One second. Question 8. So we have like data about the share prices, the dividend price, the average market return, and the dividend yield of the market also. Let me just come up with this part. So question number 8, guys. First one. The following information is available with respect to Krishna Limited. So we have the share price, we have the dividend, and average market index. So market index is given, the dividend yield, and the return on government securities. So we need to compute the beta value of the company at the end of 2015, and we have to state our observations. Okay, simple. So let's first compute. We need to compute the returns of Krishna Limited. So we have like year, and then in that particular year we need the price, dividend, then we'll say return, of Krishna Limited. Okay, so let's write down the year 2012, 2013, 2014, and 2015. So we know the prices. Prices are like 245, 253, 310, and 330. Dividends that were offered to us was 20, 22, 25, and 30. Okay, so we need to compute the returns. Now, of course, I cannot compute the return of 2012. I can compute the return of 2013 only. So how do we get the return for 2030? Well, the formula is already set out. We can simply calculate the return is equal to P1 minus P0 plus dividend, and then this entire expression will be divided by P0. Okay, so this is how we compute the return. So of course, I cannot calculate the return for 2012 because we don't have the price of 2012, right? So my beta calculations is beginning from 2013 onwards. So beta will be like 253 minus 245 plus the dividend of current year, which is 22, and then this entire thing will be divided by 245. So that gives us a return of 12.24. Same way, I can get the return for the other years also. So we calculate the returns. That's the return from the securities. Now this is the value of return that we get from the security. Now we need to also know the return that we are likely to get from the market, right? So let's do the calculation of return from the market. Calculation of return from market index. Okay, so calculation of return from the market index. Now over here also we have same way 13, 14, 15. We have got the index numbers and we have the dividend yield numbers also. So the return from the market will be like on the similar lines. We'll have it over here. It's instead of price, we will say that okay, this is index. So year 2012, 2013, 2014, and 2015. Index is given to us as 2013. Then it rose to 2130. Then it is 2350. And then it's 2580. Now the dividend yield that we have, this dividend is already given as a yield percentage. So let me count it later. Let me place it over here first. Yeah. So return over here will be, of course, computed in not in the percentage as a price, but it will be like you're looking for appreciation in index. So appreciation in index is just computed over here. Yeah, appreciation on this index will be simply computed as the rise in the value. So this will be like 2130 minus 2013 divided by 2013. So this is the appreciation percentage that we get for the index. Now from the market index, you're not just going to earn this particular appreciation, but you're also going to earn the dividend yield. So I need to count the dividend yield. So dividend yield will be like 4% in the 2012, but we don't count that. We consider dividend yield from 2013 onwards. So dividend yield will be like 5, 6, and 7. So 5%, 6%, 7% of the dividend yield. So then we say what's the total return? Correct. So total return will be simply addition of both the things, which is an appreciation in the index plus the dividend yield on it. So these are the total return from the market. So we already have now the return from the security and return from the market. We already have the return from security and the return from the market. So we can now compute the beta values. Okay. So computation of beta values. Okay, now for computation of beta values, we will need first return on market. Let me take it as X. Return on market will be computed as X. Then we'll take the return from security. So return from security will be denoted by, let's say, Y. Okay. And let's first write down the market returns. So market returns are like 10.81, 16.33, 16.79. A return from security will be 12.24, 32.41, and 16.13. These are the returns that we have from the market and the security. Now, as per our formula, with regards to security and market, the formula over here, I need to apply this formula. So let me just name it as return from market as M, and return from security maybe as S. So this is, as per our formula, we need to compute, we need to multiply them and add some more columns. So columns will be like, of course, we need to do market into security, and also we will need market square term. So market into security, you multiply the return with the return of market with the return of security, right? And then market square with the return on market multiplied by this. So we get these terms. 1 second. 2, 1, 3 over here. Yeah. Okay, so we get everything in the form of number to calculate. Yeah, so this is the correct one. So return on market and the return on security. Then we have market into security and the market square. Right. So now let us apply the number or apply the method for calculating beta. The beta is computed as summation of, or this is like n summation Sm minus summation S into summation M, and the whole thing divided by n summation M square minus summation M the whole square. Okay, so we just need the total values for all of them. Now I have the total numbers in front of you. Please substitute these values in the formula and get me the value of beta base. Give me the value of beta by substituting these values in the formula.
So we will take n as 3 or 4, sir.
Yes, yes. N will be 3.
Thank you.
Because you're taking 3 returns, the number of returns. It's not the number of prices. Okay. Substitute and give me the value of beta.
1.32, sir.
How much?
1.32.
1.32. Is it 1.32? Just check, guys. Let me also just check it independently. So this is like 3 multiplied by SM minus 43.93 into 60.7. This divided by 3 multiplied with summation M square minus summation M the whole square. No, this is coming out to be 1.91. Just recheck. Please recheck. It should be around 1.91, not 1.32. This will be like 3 into 932.38. Let me write the terms over here. So 3 multiplied by 932.38 minus summation S is 60.78 multiplied by 43.93, then divided by 3 multiplied by summation M square, which is 665.34 minus summation M, which is 43.93 square. Is it 1.91?
Yes, sir. Yes, sir.
Yeah.
My total was mistake.
Okay. Fine. So beta is 1.91. Okay, guys. So beta value is 1.91. Okay, how do we interpret this 1.91, by the way? We say if market moves by 1%, security return is likely to move by 1.91%. Okay, that's the simple interpretation of beta. So we have computed the beta values, and that's what we say. Now let's proceed with again beta calculation. But when we have a data which is based on portfolios, I mean, it's based on the probability scenario. So let's look at this question number 9 now, guys.
Sir, Abhirakesh.
Yeah.
So, what is the need for return on government bond, which has been given in last column in earlier example?
Return on government bond. That is to compute risk-free return. Like if the question would ask you what is your required return from this security, you'll take an average of risk-free securities, right? That will be your RF, and you'll use the KPM model.
Okay.
Okay.
Yes.
Okay, so that was to compute like you can say average of government security will be like, you can compute the required return is simply RF plus beta into RM minus RF. So you can just substitute the RF function over here to get the required return from the security.
Okay, thank you.
Yeah. Sure. Next, question 9. The distribution of return of security F and the market portfolio is given to us. Okay, so we have the probabilities. This is our question number 9. So question number 9, we have return from security F and the market portfolio. Okay, we have the probability F and P. Probabilities are like 0.3, 0.4 and 0.3. The returns that are likely from security F are 30, 20 and 0. 20 and 0. And for P it is like minus 10, 20 and 30. So now you're required to calculate the expected return on security F and market portfolio P, the covariance between market portfolio and the security and beta of the security. So we're supposed to calculate the expected return of security F and the market portfolio P. So how do we get the expected return of security and the portfolio? Expected security return will be simply summation of probability into F. Let's do the calculation as probability into F, right? And also for the expected return of the market, this will be probability into P. So probability into F and then probability into P. Right? Then we take a summation of all of them. Right? So expected return from the security is simply 17, and same way expected market return. Expected return on market will be summation of probability into P. So probability into P, that's already 14. That has been derived by us. Now, we already know these numbers, expected return. Now the question asks us to compute the covariance between the market portfolio and the security and the beta. So how to compute the covariance? Right? Covariance between the security and the portfolio. Covariance between security and market. So the formula for that was simply taking summation of probability into F minus expected F, and this again multiplied by market portfolio minus expected market portfolio. Right. So we need to take the deviations. Deviations will be F minus expected value of F, and then P minus expected value of P. And then we need to multiply like probability into F minus expected value of F, and then further multiplied by P minus expected value of P. Yeah. So can you compute this and give me the value of covariance? Yeah, please compute this and give me the value of covariances. We've already computed covariance quite a few times in the past lectures. Calculate the covariance in the given case and tell me the answer. So it is F minus 17. Summation, no, we don't need summation. Then P, which is the market portfolio, minus 14. And then finally it should be probability multiplied by F minus expected F multiplied by P minus expected P. Right? This way, take the total and just check if you are getting this as 168 negative. Yep. Minus 168. So covariance is minus 168. Yep, guys. Minus 168 is the covariance. Now we have to compute the beta. Now to compute the beta, we need the covariance between the security F and the market portfolio, and we divide it by the variance of the market portfolio. We already know the covariance. We just need to calculate variance of P. Now, how do we compute the variance of P? How do we compute the variance of P? Variance of the market portfolio. How is it computed? I already know that it is summation of probability multiplied by P minus expected P. Right. Summation of probability into P minus expected P. Okay, so we know what is P minus expected P. Now we just need to multiply probability with P minus expected P. Okay, so that's like probability multiplied by P minus expected P. And then we take a sum of it. One second, did I do something wrong? Probability into P minus
Square we have to take, sir.
Yeah. Probability into expected. This is to be squared, correct? So this has to be probability into P minus expected P squared, correct? So I need to multiply this again with P minus expected P. Yes. Yeah, correct. So we got the variance also to be probability into, summation of probability into P minus expected P the whole square, which is 264. So our beta value will be simply the covariance, which is 168 divided by 264. So we can say beta is 168 divided by 264. Okay. So we're getting a beta of minus 0.64. Yeah. So how do you interpret this minus 0.64? This means if there is a 1% rise in the market index, then there will be 0.64% fall in the security return. Okay. Are we good? Yeah. Okay, so that's the beta calculation when we have the data in a probability manner. Then you can take this question 10 also on a similar lines. You have to just compute the beta of company A and B, just like any other security, just like any other problem. Or let me just see if we can do some other questions. Yeah, let's go for this question number 20 now. This is an interesting one. Assuming that the shares of ABC Limited and XYZ Limited are correctly priced, then investor should not invest in, Jenny is asking, investor should not invest in securities. Beta is negative. No, it's not like that. If beta is negative, it means the movement of the security is going to be opposite to that of the market. So if you are an investor who is, who would like to make money from the falling markets, then you can definitely invest, because when the market fall, then your security prices increase. Right? So that's the meaning of negative beta. You'll find rarely any security is having negative beta number. Rarely you find any security to be having a negative beta number, because there you'll find that all those beta numbers are generally positive, or you can say just maybe 0 or maybe 1.1, 0.2, but negative beta is a rare phenomenon that we observe. Okay, question 20, guys. Let's do this question 20. Assuming that shares of ABC and XYZ are correctly priced according to the capital asset pricing model, expected return from beta of these shares are as follows. So from both the shares, ABC and XYZ, we have the beta and the expected return. We are required to derive the securities market line. When we say derive the security market line, we don't know what is the beta. We know what is the beta, but we don't know what is the market return and RF return. So we need to compute that. So let me just take down the data of question that we have. We have it for like ABC and XYZ. Then we have the beta numbers and the expected return numbers, right? So expected return and the beta numbers. So beta is basically 1.2 and 0.9. So expected return is 19.8% and 17.1%. Now this question has not given me what is RM and what is RF. So of course we can say let RM be market rate of return and RF be risk-free rate of return. Okay. So return of ABC will be derived as what? RF plus, can I say beta of 1.2 into RM minus RF, right? That being equal to 19.80. Same way, return of XYZ will be RF plus 0.9 into RM minus RF, that is equal to 17.10, right? Now, solve this equation? Will you be able to solve this equation, guys? Will you be able to solve this equation? Two equations, these are simultaneous equations. Can we solve them and get the value of Rm and Rf? Yes, sure. Give it a try, guys. Try to solve these two equations and get the value of return of market and the risk-free rate of return. Try to solve this and give me the returns of market and the risk-free rate, guys. Okay, so you get these two simplified equations. 1.2 Rm minus 0.2 Rf is 19.8 and 0.9 Rm plus 0.1 Rf is 17.1. What I can do is simply multiply this by 2. And when I do that, this becomes like 1.8 Rm plus 0.2 Rf is equal to 34.20. Right? So this is like the equation number 2, and this one is like the equation number 1. Right? So we can definitely adding equation number 1 to equation number 2. We can say Rm and Rm getting added, right? One point two, 1.8. So that will be like 2.8 times of Rm is equal to 19.8 plus 34.2. That's 54. So Rm will be 54 divided by 2.8. In 1 second, there is some mistake, I think, in our calculation. Rm minus Rf is 0.9. Where is RM minus RF 0.9? 0.9. One second. The Excel solving is sometimes quite challenging. One second. RM minus RF. This is 19.8 equal to this. Oh, let me do one thing. Solve it manually because sometimes doing it on Excel can be actually challenging.
Yes, I got RM as 19 and RF as 15. I don't know whether it is right.
No, wait. Let me just solve it. So we have two equations. One is risk-free plus 1.2 times of RM minus RF is 19.8, and the other is risk-free plus 0.9 into RM minus RF is 17.1. Okay, so if I simplify this, this is risk-free plus 1.2 times of RM minus 1.2 times of RF is 19.8. Right, and then of course we can say it is 1.2 times of RM minus 0.2 RF is 19.8. Then on this side it is risk-free plus 0.9 RM minus 0.9 RF is 17.1. So RF minus 0.9 RF, it's like 0.9 RM plus 0.1 RF is 17.1. So then we multiply this equation by 2. So this becomes 1.8 RM. Yeah, that was a mistake I was doing there. 1.8 RM plus 0.2 RF is 34.2. So this is equation number 2. This one is equation number 1. Then we say add 1 and 2. So 1.2 RM minus 0.2 RF is 19.8. The other is 1.8 RM plus 0.2 RF is 34.2. And then when we add it, this gets cancelled. We have like 3 RM is equal to 19.8 plus 34.2. How much is 19.8 plus 34.2? Which is 54. So RM will be 54 by 3. Yeah, that is 18. So we got the market rate of return to be 18. Now we can substitute this in any one of it. So we can say substitute RM is equal to 18 in maybe the first equation. So that's 1.2 into 18 minus 0.2 minus 0.2 into RF is 19.8. So once you solve this, this RF should be 9%. Okay, so RF is 9%. Now, of course, when we say the securities market line, which is the required return, that will be calculated as risk-free plus beta into RM minus RF. So we know risk-free is 9 Beta will differ according to the stock. So it will differ from one stock to other. So beta will differ. And then we say RM is 18, RF is 9. So this is simply going to be 9 plus 9 times of beta. That's the required return which we have from a security based on CAPM, based on the CAPM model. Okay, so based on CAPM model, this is what is the required return. Okay, fine, clear. Now let me take another question. Yeah, let's consider this question number 19 now. The following information you're welcome, Jenny. The following information is available in respect of security X. So we have the equilibrium return. Equilibrium return means we're talking of the CAPM return. So equilibrium return is given as 15%, right? So equilibrium return is just 1 second. Question ran up. Equilibrium return is 15%, which is the CAPM return. So this is our CAPM return. Okay. Market return is also 15%. So RM is given as 15%. 7% treasury bonds trading at 140. What is the RF? How much is the RF here? How much will be the RF guys over here? RF won't be 7% because 7% is the rate of coupon, whereas the bond is trading at 140. So RF will be the amount of coupon upon market price of risk-free bond. Okay, so coupon is going to be 7, or for which you are going to pay 140. So RF will be 7 divided by 140, which is 5%. Okay, so RF is 5%. It's not 7%. Right, so it is 5%. Then covariance of market return and security return. So we have like covariance. Covariance between the market and the security, or consider covariance between the security and the market is 225. Coefficient of correlation. Okay. Correlation is given as 0.75. Right. So correlation is given as 0.75. You are required to compute the standard deviation of market return and the security return. Okay. The standard deviation of market return and the security return. For that, we'll have to take help of CAPM return, or the equilibrium return, which is the CAPM return. CAPM return, we compute it as RF plus beta into RM minus RF. And this is given as 15%. Right. So, RF is 5% plus beta into market rate of return is 15% minus risk-free rate is 5%. This is equal to 15%. From this expression, can you tell me what is the value of beta? What's the value of beta, guys? Solve this and give me the value of beta. Solve this and give me the value of beta, guys. How much is
1.
beta equal to? Beta is 1. Right? So we get the beta value as 1. Now, as the beta value becomes 1, we can actually calculate the other terms also. So beta is essentially 1. Now, how is beta really calculated as? When we have the covariance, can we calculate beta by some form? Beta is calculated as what? Covariance between the security and the market divided by variance of the market. And we know that this is equal to 1. Do we have the covariance number? Yes. We have the covariance number as 225. And we need the variance of market. So 225 divided by variance of market is 1. So what is the variance of the market? How much is the variance of the market? Variance of the market is 225. So if the variance is market, the question is asking the standard deviation of market. What will be standard deviation of market return? Can say it will be square root of 225. So it is square root of 15. Right? So we can say standard deviation of market return is 15%. Okay, so we got the standard deviation of the market to be equal to 15%. Now the next thing asked in the question is, what is the standard deviation of the security return? Because they say standard deviation of market return and standard deviation of security return. How do we get the standard deviation of security return now? For that, we'll have to use another formula of beta, which was correlation multiplied by standard deviation of the security divided by standard deviation of the market. We had a beta formula like this also. So now I can apply the same formula. Beta 1 is equal to, correlation is given to us as 0.75. This 0.75 multiplied by standard deviation of security is something which we don't know. And the standard deviation of security upon standard deviation of market is what we have already got this as 15%. Right. And then, so what will be the standard deviation of security equal to?
20.
Standard deviation of security will be equal to 15% divided by 0.75, which is nothing but 20%. So we get the standard deviation of security equal to 20%. Okay. So we got the standard deviations of securities as well as standard deviation of the market in this question number 90. Okay, so we have done good number of questions for KPM. And we have also understood the concept with logical clarity. I hope I have done justice for the concept. Now it's time for you. If you have any queries, you can just raise your hands and ask it. No queries?
Okay, I think Bandhu sir, there is no query on query handle also.
Yeah.
Okay. Okay, student. I think today's session was very knowledgeable session because Bandhu sir has started with the. I liked very much how you have linked the economics with this concept. In earlier class, you have linked the concept of mathematics. So it is very interesting part. More importantly, this topic is if we consider number of pages, so I think this was one of the topic which has a maximum number of pages, and it is very important topic because it helps us to minimize our risk. But please, student, remember one thing. After going through the topics like portfolio management, derivative analysis, some students start indulging the trading in the market. So as in my earlier class, I have our disclaimer is that please don't indulge yourself in the market trading, etc. Of course, once you qualify the same exam, you become the chartered accountant, then you can do at your own. And here in the class, we have discussion about basic concepts of portfolio management and other models as well. So I think, sir, in the next class, this chapter will be wind up.
Yes. Yes.
Okay. Okay, student. In the next class, we will finish this chapter, and I hope with this finish of this chapter, a major portion of your study material will be covered. Okay. Yes. Okay. Okay. Jeannie, thank you very much for your appreciation. And we really appreciate if students give their feedback and as well as their suggestions in any study material. It will be these are always welcome. Okay, student. With this, we come to the end of the session. Bandhu sir, thank you. Thanks a lot for sparing your precious time and enlightening the student on this topic. And student, thanks for patient listening and have a nice day. Thank you.
Thank you, sir.
Okay, thank you. Yes, sir.
Yes.